We are in Track A, Lean Marketing Strategies and Nimble Growth. And we're going to kick off by talking about marketing automation, scalability, scaling campaign success with small teams and limited budgets. Sounds familiar to me. Most of my clients fit that description. So Matt Roche, the CEO of Extole, is going to come up. Thanks a lot.
Appreciate it. All right, come on, people. I know you're saying, just what I need, another old white dude. All right, so I'm here to talk to you. I mean, I don't know how you felt about this morning. Sorry about that. I don't know how you felt this morning, but AI, there are some days where I'm like, this is the best thing that has ever been invented, and then there are other days where I literally want to just cower in a corner and make it all go away because it is so terrifying. All right, so part of this is a presentation to give you a little hope, right? So we're in uncertain times. I don't think anyone is confused about it. What I want to talk to you a little bit about is this volatility. I want to talk about trust, and then I want to talk about referrals. Refer a friend. So when you are in uncertain times, the most resilient growth is not bought, it's earned. If you get nothing else out of this presentation, it's that. We are in uncertain times. You are not going to be able to reliably buy your revenue. You are going to have to earn the revenue, and I'm going to walk you through how we can get there. So, COVID, a couple years ago, predictable things happened, like business didn't go in exactly the right direction. Of course, they recovered quickly thereafter. CPMs dropped. That was nice. I mean, those of us in marketing, it's like, wow, we can actually afford more now. But it was more because people were sheltering in place. This was not going to last. What was not predictable was lots and lots more digital account opening. Credit unions and fintechs increased market share. So we've now turned from this big bank-centered world into a dogfight between new tech, fintech, and credit union. Increase in deposits, actually slower consolidation. Then we get into the 2023 banking crisis, right? And this was tough for me because I am a loyal banker. Like I banked with one bank for 20 years, and early that year, that bank failed, and that sucked. Right? I had no reason to ever change what bank I was in. It was First Republic. It was the best bank. I'm sorry, at the time. But there was all sorts of things that you'd say. Well, when there's too much uncovered risk, we're going to have a crisis. Eventually, we had the crisis. We did not expect a Swiss bank to fail. I mean, that wasn't a thing that was on anybody's bingo card. We did not expect that bonds would become a source of risk. I mean, all sorts of things that you can't, you're saying, I think I know what's happening next. You're not going to be able to predict what happens next. So glad that all this is behind us, right? So now everything is going to be safe and stable and cool. Yeah, not a chance, right? All the policy shifts, like who the heck knows? I mean, are the consumers, do they have money? Do they not have money? Are they going to be able to take out loans? Are they going to be able to pay their loans? Who the heck knows, right? Is banking becoming easier or harder under Trump? We don't even know, right? All this change in AI is probably the biggest one that's most closely impinging on us. It impinges on me as a marketer, even though I am a tech provider. It impinges on me as a marketer because I have to figure out the same exact things you do about content, et cetera, et cetera. And then the affordability is going crazy, right? There is that big tech media is not becoming more affordable over time. And then there's this. Like, seriously, who the fuck is it? Sorry. Didn't mean it. So this is his idea, is you are a business, you're going to come to us, you're just going to tell us what you want, right? You're going to connect your bank accounts, so don't even need to worry about thinking, people. Just literally just sit there, do TikTok or something. We're going to do marketing for you, right? So how do we think that that's going to work out, right? They're going to do your creative? Now, according to earlier today, they'll do better creative than we do, and it's entirely possible they may do better creative than we do. They're going to do all the bidding, they're going to do all the buying, they're going to do all the creative, and you're just going to sit there and get cockadoodle profits, right? I think that's extremely unlikely. I think it is likely that they will get very, very good at using AI to do creative. I think it is likely they will get very, very good, and they are very, very good at audience modeling at understanding what's going to drive new accounts. I don't think it's going to end well for us. Because if somebody gets that good at it and we are get that dependent on it, suddenly it's going to be 2 years payback period on a new account. 5-year payback, infinite payback period. We may pay them to run our businesses. Who knows? So you cannot rely on this. You cannot say, oh, this is going to make our job so much easier that I can hand it over. And this is what they want. This is how they would like to have advertising go. And this is going to affect everybody in this room, including me. So I believe if you want stability in these times, when that is a radical instability, right? Like marketing is changing at a speed which is unfathomable to me, back in the 2000s, when I was doing online direct marketing. It's unfathomable, and it's happening every few months. So in order to get to a stability that allows you to do the job, it has to start with your customers, because it is the one thing that you quote unquote own. And the basic rule is lifetime value has to exceed acquisition cost. I know this is real serious stuff. Write that one down, people. You can't control the macro, but you can stabilize through loyalty, advocacy, and referrals. There's a term that I call, so good customers don't want to change banks. Now, earlier people were mentioning, if something goes wrong, and I've experienced this. My business bank, I don't love the people we do business banking with. I don't love our business credit card, honestly. And if something else came around that at a better rate or that would give us a bigger line of credit, I would be gone in 2 seconds. I am not a good customer of this card. I'm just not. There are other things I have, like I'm okay with my personal account at this point. Good customers, though, don't want to change banks. And all of us have plenty of good customers. Right? They do it because they have to. And that inertia, I want to keep working with you, I want to keep banking with you until you screw up, is to our advantage, provided you don't screw up, right? That people will stay around. And so you got this incredible volatility in AI, incredible volatility in PPC, and what exactly is Mark Zuckerberg going to do? But you pretty much know that a good customer will stay with you, right? So the big question is, how do we get good customers, right? The institutions that thrive will be those that foster genuine loyalty and word-of-mouth advocacy, period. If you want good customers, how a customer enters defines how they leave. If a customer comes for a good rate, they will leave for a good rate. If they come for some fancy tech thing, they'll leave when the next fancy tech thing comes around, right? If a customer comes in because someone they know brings them in, they will stay longer. We know it because I've been doing this 12 years, and it's always the case. Now, does anyone know, where's my slide? Oh, this is called earned growth, all right? And I'm going to use this term as we talk forward. Earned growth is everything that is not paid growth. So earned growth is when I refer someone. Earned growth is when someone sees a rating or review somewhere and comes in. Earned growth is when I have someone open an account and they then get a car loan. It is I have earned that through the service I have provided to one customer. It's different than earned media, by the way. And there was a study done, there's a report in Harvard Business Review, it was a study done by Bain, the guy who actually created NPS, created a new NPS 3.0, and he demonstrated that enterprise value correlates with the percent of your growth, which comes from earned growth. And earned growth, the simple rule is, again, it's just not paid growth. So, how do I do this? Does anyone know what that is on the side? We called it a passbook. It's a passbook. It is a passbook from Norwalk Savings Society. Anyone remember actual savings and loan? Yeah, I figured. The other guy from Wilton. By the way, we're from the same town. It's very odd. So that is actually my passbook. I do not know why I still have it, but I still have it. Look at the incredible balance there. I think it was $43.38. Back then, it's probably still worthless, even at today's dollars, but that was how we banked. Why did I bank there? Anyone want to guess? Because my parents banked there. Right? Why did anybody bank anywhere? Because their parents banked there, or because their friend banked there, right? So that was the heart of all of it. Is these are businesses that are extraordinarily difficult to tell the difference between from the outside. It just is. It's very, very difficult for a normal consumer. Normal consumers are not good at buying things that they don't buy very often. We are terrible consumers of mattresses. Right? Because who buys a mattress? I mean, it's like a couple times in your life you do it. So nobody's going to get good at it. Banking is that way. People are not generally good at buying banking, so they need signal from somewhere else. And this is all of banking. This is brokerage, credit card, insurance. They need something to help them along, and inevitably it is going to be someone they know. Now, it could be someone they know digitally, and it could be some fake AI avatar in the future, God willing. But it's going to be someone they know, right? And so the 3 steps we have to increase the earned growth, to increase the growth from this is, number 1, quality. Everyone here, when they do online direct marketing, you saw the spreadsheets, the eye chart spreadsheets earlier that said, I'm getting 2% conversion rate, 3%. Almost everyone here on almost every form of marketing is measuring by conversion rate because that's sane and because that number is available, right? The problem with conversion rate is you're always just saying, did they open an account or some sort of first step? And it doesn't really differentiate between someone who came because you have a temporarily good rate or a temporarily good offering, or whether somebody came and is going to stay. And so we need to expand that lens a little bit. I'll talk about that for a minute. But if we expand the rate if we really think about quality and we apply it to earned growth is going to get you 10% to 45% of your new to file. It is possible to do if you use this. Onboarding, the second, is saying how you treat someone in the first few months is going to affect the likelihood that they will participate in earned growth, and then advocacy is the heart of the whole thing. So, quality. As I said before, you cannot make an unstable customer stable. That is not a thing. So there's been presentations over the last 20 years about here's how we're going to use loyalty and points and all sorts of different things to increase the long-term value of customers. What I'm going to tell you is, in our experience, how someone enters is how they leave. And so how they are positioned early on, the experience they have early on, is what develops that inertia that keeps them from churning, keeps them from saying, well, it didn't really work that well for me, I'm going to look around. Right? How they enter is how they leave. Unmotivated, mercenary entry is going to lead to prick chasing. It's going to lead to low retention. Stable customers come from stable customers. If someone comes in through referral, they will be about 115% the value of someone who doesn't. It can be higher in some cases, depending on how you treat them later. But across the board, you can actually look through your data and find your referral traffic simply by looking at who is more profitable. And in fact, this helps us with attribution. We can actually tell whether we can differentiate referral quality versus non-referral quality simply by looking at the long-term quality. The terms and conditions are the magic of referral. So if you want quality, and quality in many cases will be, are they doing direct deposit? Are they applying for a loan? Are they using their debit card? Right? We know what these are. These are not hard things to do, and it is possible to measure them. You may not be measuring it this way, but it is possible to measure, and it is not all that hard to measure. And if you can do this, you can actually get an index that says, I'm not just doing it based on conversion. I got 37 conversions. I got 200 new accounts. You're saying, as of, at the 90-day point, this source of traffic gave me X% high-quality traffic, and this form of traffic gave lower quality traffic. Referred source customers will show about 15 to 30% higher qualification rates, and programs that have, and I'll get into how this works, programs that have rewards tied to qualified behaviors will usually increase the conversion of those behaviors by about 10 to 20 percentage points. So Google and Meta are going to charge you whether they're good or a dud if you get your terms right. If you say, I will give you $100 if you bring somebody in and that person sets up direct deposit. Or if you give additional rewards for setting up, then you will actually tune your marketing towards not only earned growth, but also high quality earned growth. Second part is onboarding. So 40% of fintech signups abandon. The number one reason is difficulty sign up for direct deposit. What happens in the first few cycles of bringing somebody on board will be the difference between whether you create a new advocate or don't create a new advocate. Remove friction, drive engagement. The way I look at this, and this is also a little bit of an eye chart, but I'm going to try to maybe walk you through it. You got your customer journey. All of us have seen journey charts before, right? This is someone who I kind of am interested in the bank. This is somebody, okay, now I'm actively considering, I have some options. I applied, I submitted, my account was improved. Then you start getting into the other ones. I installed the app, I connected direct deposit, I used the debit card, and then the really high value stuff, I referred or I became an ambassador. So this is your new journey, right? Frankly, a lot of people stop here. I did my marketing, I opened an account, right? And so therefore you are using money to drive people from left to right. It's just you're giving all that money to Sunnyvale and you're giving all that money to Mountain View. We'd like you to direct a little bit more towards your customers. You may have a welcome offer. You're directing people towards moving from the left to the right. Right? And it's just a good model. What I want you to do is to start thinking about these steps beyond it, because these steps are quality and these steps are advocacy. And this is where the earned growth happens. And we can use incentives and programs to drive people from the left to the right. There are more people on the left, fewer people on the right, but the farther to the right you get, the longer they're going to stay. And how you do it matters. So if you really want a strong referral program, you can't just say, here's a number to bring into the branch. You have to have multiple program types. So you have welcome offers, you have referral offers, you may even have employee referral. You want to be in banking and in the app. You want to be in the branch. In a lot of cases, we'll have people with printable forms that you can go on and say, I just want to print it out and hand it to my friend. They can hand it to the clerk. They can type in the number and do it. Listen, if people are going to go into branches, and actually a lot of Gen Z does go into branches and not digital, it makes a huge difference. So making that experience clean all the way through off, and then bursts is you have to change things. I really like the first presentation where you're showing all these different creative options, because I used to run a company that did A/B testing. It's now called Adobe Target, but we would do that all the time, and we would see like, oh, this particular landing page worked 3% better than another landing page. And then we would find out 2 hours later that the other landing page was working 2% better than the first one. And then the next day, the third one was winning. And so we learned a very valuable lesson about A/B testing. Stop the test as soon as you have the answer you like. Don't say you got nothing out of this conference. The real thing that we learned about it was something called the Hawthorne effect. Hawthorne effect is named after a GE factory in Hawthorne, New York, where this clever guy said, I'm going to increase the lighting on the line as a way of increasing efficiency. They put more lights on the line, efficiency went up, they're like, great. Then this other guy, and we've met this guy, total pain in the ass, goes, I'm going to lower the lighting. Lowers the lighting, efficiency goes up. What do we learn? That it turns out sometimes novelty matters. That you have to change things. You have to say it's back to school. You have to say it's Christmas. You have to say, you have to address people in different ways. Like, you may need all 60 of those calls to action, and you may just want to rotate them. And that may be the best strategy to do it. So a burst for us is a short-term change that just says, hey, we're going to increase the offer, we're going to change the offer. Maybe this week we're going to do donations to a nonprofit instead of giving you money. But all of these things are ways of, change gets attention, attention gets engagement. That make sense? Good. Remember, in any investment you do in referral, advocacy, ambassador programs, one of the real hidden and kind of undervalued part of it is anybody that participates in a program tells you how to reach them. And reachability is a gift. And it is one we should not get accustomed to, because as things move to GPT, Amazon's new kind of LLM-driven marketing, when they sell the product, this is not for you, this is inside of retail, but I work with retailers as well, when Amazon sells that product, they will not tell you who the customer is. Now, obviously, your bank, you're most likely going to get it, but you're not going to get necessarily the right to talk to them. And so all these programs that we engage people, they give you your SMS, they give you the email, you get the reachability. Reachability is a gift. So the third is that advocacy matters, not just on a one-to-one basis, but it actually grows. So the first goal you'd want to have if you build a referral program is to get the highest number of your customers participating in it. Because if you want to have your biggest amount of your customer base coming through earned media, you actually have to have a bigger part of your customer base asking people to come in. I know it sounds really obvious. And so you want to say, how do I expose this to the most number of people? In fact, we just did a study on one of our programs. We do it for one of the big cinemas. And the program's fine. It's not great. And so they went out into the market and they talked to their loyalty program owners and said, what do you think of our referral program and what should we do better? Anyone want to guess what their answer was? What referral program? A program that nobody knows about is not going to drive a lot for you. And it seems like, there can sometimes be this sort of, I don't know if I want to put it everywhere. Is that too much? Everywhere, literally everywhere. Tattoo it on your arm, right? Like you cannot promote it enough because it is viewed by people as something that rewards them. It is viewed by something that's valuing. Being a referrer, what we call an advocate, should be a presumed part of participating in a brand. And by the way, whatever everybody told you for years about what a brand is aided recall, unaided recall, any of this stuff, a brand is the sum total of conversations happening in any given period of time about your company. That is what it is. You can drive these conversations. What ends up happening over time is you try to get to, let's say, 20, 30% of your customer base referring. What you'll see over time is that some of them will do it more often. And what you can do is create a separate program for them that says, you are now an ambassador of our brand. It has a different way of being paid. And they're not affiliates. These are ambassadors. An affiliate is someone outside your company that's getting paid to bring somebody in. An ambassador is essentially an affiliate that enjoys your brand and uses it. And it does build this way. And we have these maps. These are real maps of customer relationships inside of our tool. Right? And you get people who have this phenomenal spread. That's probably a YouTube channel. I mean, honestly, it's a bunch of people clicking. But, there are people, all the green circles are accounts created who really do impact quite a bit. And all of those people coming in will be 15% more profitable on average than the ones who come in through search. So the more you can do this, the greater you can drive it and expand it. And in a really nicely running program, you should be driving an equal number of accounts from a small number of ambassadors as you do from all of your standard advocates. It's just a rule of thumb. And so that's advocacy. Finance is a networking activity. As I mentioned in the past book discussion, PayPal would not exist without advocacy, period. If they had to buy their media on the open market using Trade Desk, they would not exist. And if you are going to buy all your customers on the open media on Trade Desk, you will not exist. It is not an economically viable activity to drive all of your customers through media. You need to do some amount through it. I call it baseload marketing. It's the thing that can keep going when you say, oh, now it's TikTok, now it's Snapchat, now it's Meta, now it's GPT. I mean, you're going to have to be cycling through these. You can always have this program. You can always rely on it for a certain amount of your acquisition. It is your baseload. All these grew through referral. The other interesting thing about it is I say when you bring someone in through earned media, earned marketing, they are stickier. It also makes advocates stickier. I tell customers, listen, run the program and try to get every single person in your customer base to advocate, even if it's unsuccessful, because that will make them stay longer. Simply repping for something makes you more loyal. So, uncertain times, you're not going to be able to buy resilient growth. And you're not going to be able to do it consistently. It is just too hard. I suffer from the same problem. I have the same meetings every week with my head of marketing that you have with your CEO or your boss. It is the same question. Why isn't LinkedIn working? How do we do content? How do we get our content indexed on AI? It is the same conversation. Referral gives us the baseload because it's earned. So, as I said, noteworthy thing about uncertain times, I cannot tell you what's going to happen next. I really can't. As I say, it's difficult to make predictions, especially about the future. What I could say is if you do the right kind of earned marketing, then you can have something that you can rely on. And in markets like this, that matters. So, last thing I'll leave you with is some things to measure. If you are not doing advocacy and referral, come talk to me afterwards. That's my pitch. Our name is Extole. I tried to keep the whole I'm a vendor thing out of this, but yes, I am a vendor, and yes, I need customers. The number one thing is what percentage of your customers come from other customers. If you don't know that, learn that, because that is essentially you have to grow that number. What percent of those customers activate and stay? This is the quality metric. Do you even know what your quality is of customers? Do you know for each lead source whether they do the debit card, do the credit card, whichever the particular post-account opening actions, know them and understand the difference in quality between your channels, including 90-day retention, and then are your onboarding journeys optimized for these behaviors. Are you asking for a referral? I mean, I think you should give a double offer inside of the first 90 days to every new customer you bring on, because someone who has referred once will refer again, and that is the sort of core engine you'll have underneath. If I haven't made the point enough times, the customer is the rock. It is the one thing that Facebook does not own and OpenAI does not own, and you don't really own them, but they're the closest thing you have. Build the business from them. Thank you. Do I get to answer questions?
Yeah.
Come on, people.
I've got a bunch of questions.
Don't leave me hanging. You lifted your coffee. That's almost the same as raising your hand. Your water, okay.
People can't find you if they don't know you even exist. So people can't find you if they don't know you exist.
Yes.
A lot of the smaller companies need to put themselves out there with paid content just to let their groups know they are, to then build. You need one to then build to two, to build to 5 to 10, 20, from there on out. What about that in the whole process of new audiences are coming up every day?
How about a wait list? Just do a wait list. Do media to a wait list. All right? And then once they're in on the wait list, say you can get higher on the wait list if you refer someone. Right? You have to start it from the beginning. Obviously, I mean, this is a chicken egg question. If you don't have a company, you're not going to have customers, which means you can't have advocacy. But the first thing you should be asking when people come in is to bring in somebody else. The earlier you start, I mean, PayPal would not exist, right? Frankly, I think OpenAI wouldn't exist if it weren't for referral. Now, they're not paying for it, but do you think you would be using it if it weren't for some kid or some sister or brother who's like, oh my God, you got to try this, right? And then you talk about it. So it's, I would do a wait list in that particular case.
So getting back into, these 3 steps, how exactly does automation and filter into how you increase your earned growth?
I don't think people should be running their own referral programs. But then again, I'm a referral platform vendor. So, I mean, you can call me biased. The reason I don't is when people run them themselves, a lot of times, and I'm certain there's someone in this audience who does this, they have a bunch of gift cards in a drawer. And they say, oh, tell me on an Excel spreadsheet who did it, and then they'll send out those gift cards, right? When I say terms are the most important part, it just means the program rules. It's saying that you have to have done this to get this. You'll waste so much money on rewards and on the time spent handing out all these gift cards. There are cheap solutions. If you just need to get something run, you're not going to use us. I mean, we're not $500 a month, but we work with a lot of credit unions. We work with a lot of regional banks. And what we can do is automate all of the rewarding, all of the fraud detection, all of the anti-risk, all of the program terms, so that you can focus on saying, how much do we want to give for what? That make sense? I don't think I answered your question, though. Ask again. Okay.
So I'm curious, you said how they come is how they leave. If they're coming for a referral incentive, are they coming for the incentive?
It's really weird. That's a great question. Why is an incentive not the same as a lower rate? I don't really know. I think it's that there's another person attached to it, honestly. Because I think that you don't see the same on a welcome offer. So if you're considering an A/B test, a welcome offer would be the same payment, but no referral, versus the referral just has higher value. The person stays longer. So I think it boils down to someone says, oh, I need a new bank. And you're with them on a Saturday night or you're with them on a Sunday by the grill, and they say, I use these guys, and I like them. Oh, and you know what? I think I can get you $50. And that makes you do it. And then you go onto the app, which is why, by the way, it should be the first thing you see on the app. And then they say, and then they sign up, but it wasn't the $50. The $50 caused you to do something. The $50 it was because of you. You have a question?
No, I'm
sorry. Oh, wait, I'm sorry. One more? I got 2 seconds.
One more. You're too interesting.
You had to profile the best positive referrer, age, gender, who would that be? Because I have a opinion.
What's I tell you is very interesting. I don't know that I can answer that. Our sort of prototype is this customer we have. I call her Blair. Her name is not Blair, but we know her customer. She is newly married woman, and she was a lousy customer of 5 of our brands, like kind of $100 a year, $150 a year, nothing you'd write home about. But she drove $90,000 worth of business. And there's something, I don't know really why. It wasn't she had a big Instagram account or something. She just evidently talked about it a lot. Right? So I think that is the right, but I've never been able to predict an ambassador. Please.
Professional, and I heard this 20 years ago, and every referral program we've done, loyalty program, that tends to be where we get the best traction is women, mid-30s, earning a salary are great referrers.
Yep.
And just, it helps to kind of have a target when you think about it.
All right. Thank you for the time. I
That was a
appreciate
great
it.
talk. Thanks so much.
Thank you all.
Appreciate it.